Hello, Dylan Langei, branch manager and home loan officer at Evergreen Home Loans. And today I'm going to show you how you can secure a low rate, potentially near the 3%, at least for the short term. It's something with one of our innovative products, one of Evergreen Home Loans' innovative products called the Seller Buydown. This is how you get an extremely low rate on the seller's dime. This is no money out of your pocket, but you need a very educated real estate agent and lender to work on your side to negotiate with the seller to make this program happen. I'm going to give you the details here. And just a reminder before I dive into this, WhatcomHomeLoans.com, that's my website. That's where you can see all of my mortgage updates, all of my other videos, testimonials, why I'm the number 1 rated lender in Whatcom County. You can get a rate that doesn't take a full application. It doesn't pull your credit, doesn't cost anything. Very, just a lot of resources here on the website. You can subscribe to my YouTube channel so that you can get these videos weekly, and you can contact me with any of those buttons or follow me on social. Alrighty, so let's dive into it. So how do I get a low rate on the seller's dime? Okay, so this is a seller buy down program. This is actually on a loan that I am closing right now. This is a real deal. This is active. This is not a made up fantasy. This is not pretend. This is real. So Fannie and Freddie and FHA, all different loan programs set actually a standard, right here, on max IPCs. What IPCs are interested party contributions. That means interested parties are the sellers, realtors, builders, anybody that's an interested party in the transaction is an interested party. So if they contribute money, it's an interested party contribution, an IPC. So depending on the program that you go with, there's max IPCs, which I'll tie this together with how we get that extremely low rate. So you'll see here, they have the transaction and property types, what these are eligible for this seller buy down program. So this is only eligible for primary residence and second homes, not for rental properties or investment properties. And it doesn't work for cash out refis, ARMs, or manufactured homes. So the general requirements, you can read through these, pretty standard. But here are the IPC. So this is what's important. If you're doing a conventional loan and you're doing less than 10% down, the seller or the realtor or the builder can only contribute 3% of the sales price towards a credit to pay for this seller buy down program. If you're doing between 25% down and 10% down, they can do 6%. And if you do more than 25% down, they can do up to 9%. On FHA, it's 6% total. VA is 4%. USDA is 6%. So let me just give you the basic, what is this program? Essentially what this program is the seller is prepaying your mortgage payment. They are prepaying it for the first 1, 2, or 3 years. You have a starting note rate. And in this scenario with this client, it was 5.99%. That was her starting note rate. How this works is on the 3-2-1 buy down, it's the first year that you have the loan, the starting rate is 3% lower than your starting rate of 5.99. So my 5.99% rate, the first year, look at that, 2.99%. That is what this client would be paying on the first year, is 2.99% for 12 months. So if you look at this scenario, this is, once again, one of my clients, $475,000 purchase price. They did 20% down, so $380,000 loan amount. Their starting rate was 5.99% on a 30-year fixed loan. This is their monthly payment on their principal and interest. This does not include taxes, insurance, or anything else. Just principal and interest is $2,275. Well, on the 3-2-1 buy down, right, the seller is prepaying your mortgage payment. They're not buying down the interest rate. They're actually prepaying the mortgage payment. But what they're doing is they're prepaying it to set the payment at 3% lower than your 5.99 start rate for the first year, then 2% lower for the second year, which is 3.99 right here, then 1% lower, which is 4.99 for the third year. 3 years of lower payments. So what it is, so this is your P&I payment at the 5.99, right? The 2275. Your P&I payment on 2.99 is $1,600. You're saving $675 a month for the first 12 months, which is $8,100 in the first 12 months. Then you're saving $463 a month for the next 12 months for the second year, which is $5,500. And then you're saving $238 for the third year, which is $2,859. So what we would need to ask for from the seller is a credit of $16,534.92. A lot of people watching this might be like, Dylan, you're insane. No seller is going to give me that. You better check twice. Sellers are getting really, really desperate to sell their homes, and there's a lot more negotiating room than one may think. That's not on every house. That's not going to be in every market, but there's a lot of negotiating room right now. So where I think this program is really, really key and important is if you think rates are going to go down in the next few years, or maybe this is a short-term home, this is a great program for you because your interest rate is super low. Your monthly payment is super low for the first 1, 2, or 3 years, right? It's not for 30 years. It's for 1, 2, or 3 years. If you don't think rates are going to come down, or this is a forever home and you're going to be in there 10, 20 years, which pretty much nobody ever stays in their home that long, then maybe a permanent rate buy down would be a better option. But here's the 2-1 buy down, right? Let's say the seller doesn't want to give $16,000. Well, we can still do the program, but just do it for 2 years rather than 3 years. So same principle. It's 2% lower than the 5.99 for the first 12 months. You save $463. Then it's 1% lower, and you save $238. We only need to ask the seller for $84.25.32, and you will get this lower payment for 2 years, right? It gives you a little bit of a cushion. It also helps you work into that payment as well. So you're not coming out of a rental or maybe a low interest rate, low monthly payment because you refied in 2020 to a 2.75. It helps you get used to this payment. A lot of people ask me, well, hey, what if rates drop to 3% and I refinance? I don't want to lose this money. The good thing is the seller has prepaid your mortgage. So your payoff is just going to be lower by $16,000, $8,400, or $2,800 because they've prepaid the mortgage payments. So you don't lose this money like you would if you do a permanent rate buy down. You're just prepaying the interest rate. You're buying it down permanently. And that's a one-time cost. That's a sunk cost of doing the loan. And you do not get that back if you refinance. So there's always a break-even point on that piece. So that is the Seller Buydown program. Once again, you need to be working with a trusted, educated real estate agent and a lender, and also a lender that offers this program. Once again, this is not a one-size-fits-all. This is not a program that works for everyone, but it is a great, great program to step into maybe these higher rates, but take a way lower rate early on and get used to that monthly payment and potentially wait for interest rates to drop. So if you have any questions, feel free to reach out to me on Evergreen Home Loans' innovative product, the Seller Buydown program. It is an awesome program, and we are doing a ton of these. Catch you next time.